Okay, welcome everybody to episode 75, and we are back in 2024. This is actually the first one we've done in about 6 weeks, and as always, I've mentioned this before, but even if I just take a few weeks off, I actually feel pretty nervous. Not only just speaking in front of camera, I was always kind of nervous speaking in front of a camera, but also just the setup, the sound, so definitely let me know right away if there's something wrong with the sound. For anybody who has been following me on Twitter, I will show you. I basically moved into a new place, and that's why there was a delay so far. I was kind of setting things up. But this is what it looked like. What is this? January 19th. This is the live stream studio as of a few weeks ago. So I had to order a bunch of stuff off Amazon, sound panels to deaden the sound. And so what we ended up with is what we've got right here. So hopefully this is good enough to look at. As always, you know I'm a minimalist. I don't have a whole lot of stuff. So it's mostly just my hobbies. I do a little bit of golf and I'm a runner. So, I just throw all my shoes on the wall. And of course, I'm kind of a shoe guy when it comes to running. These are just the shoes I've bought in the last sort of 6 weeks since I've been here. I basically get a new pair of shoes every 2 or 3 weeks. But yes, so welcome to 2024. I thought the first segment today, what we would do is I would just go over really briefly what we're actually going to do over the next several weeks, the next several months. Got a couple of courses that I'm launching, totally free, totally open to the public, but I did want to go over that. But one thing really quickly, I have resumed on YouTube, and I was pretty inactive for a little while. And what that typically means is, as far as the YouTube algorithm goes, I'm probably going to be quite invisible. So if you could do me a favor, really get pretty aggressive in the next several weeks on the like button. Every time you see a video or a live stream, you'd be doing me a really big favor to just hit that like button. Just remind YouTube that I am actually still here, and there's a few people who are interested in what I have to say. So like I said, let's get into what we're going to be doing over the next several weeks. And of course, you can start putting your questions into the chat section if you like. But what I'm essentially planning on doing is I'm going to go through in much more structure over the next couple of months a couple courses. So the first course is going to be this one. This is the Total Portfolio Solution. If you follow VTS or if you follow my live streams, you will be aware that we actually have a portfolio currently of 4 strategies. So this is the website. You can go watch the individual strategy videos or the whole thing. But what I'm going to do to just break it down in one place, because I've basically at this point, I've been doing this for 14, 15 years on a public website, and it's pretty overwhelming. There's over 1,000 articles, hundreds of videos. So I'm going to go back to the basics, and I'm basically just going to unpack really quick, hopefully 5 minutes. You know me, I can ramble a little bit, but hopefully little quick 5-minute videos, basically capturing anything that I can think of about our portfolio. So I've got a rough outline. Of course, this is not written in stone, but you can see it's going to be a pretty detailed course. So that's the first one. You definitely, if you're interested in what I do at VTS, you will want to give me a follow and you'll want to tune into these. I will be uploading all of them on YouTube, so this is nothing paid or anything. And then the second course will be very specific to volatility traders. So I'm going to go through all of these metrics. Again, rough outline. This is not written in stone, but where this is coming from, this is our daily email. You can see the portfolio. If nobody's seen this, maybe I'll go through it really quickly, but strategy, trades, people get the trade signals every day for the strategies, little blog article, whatever. But down here, you can see we have a volatility dashboard. And there's actually quite a few metrics that I use in my trading, like beta factor. I can measure how exposed my portfolio is at any given time to the market. And then this is really the heart of our trade signals. We've got all these volatility metrics. And anybody who's in the community, of course, they can just click on these. And these are all articles, right? I do actually write quite a few articles. And some of these tell people how to calculate stuff. So, basically you get the point. There's articles for all of our volatility metrics. But what I'm going to do is I'm actually going to go through and make a full video series as well. Some people like to read, some people like to watch videos. So I do actually want to have it. So in our emails, there will now be an article and a video for all of these metrics, plus a few more things that I can think of along the way. So that's basically where we're at with respect to that. And just really quickly, I do actually want to remind people, Yes, I do write as well. Some people find me through video content or live streams, and they don't fully realize that. Some people don't even know I have a website. So this is my website. I very rarely am on here. It's just a basic website. But you can check this out. Of course, the portfolio stuff is here, strategies, performance, and whatnot. There's an about page if anybody's actually interested in how I came to be in this business, you know, from a former pro golfer to now managing portfolios. But what I wanted to point out really quickly, if you go on the website, you can see the videos. It's all segmented off. Everybody kind of follows me because of these. This is what you've seen on YouTube. Live streams, you can ask your questions. They're all up here. This is the thing people don't actually know that I do. So I actually do write quite a bit as well. This is, let's say, just the last 6 weeks, just in 2024. There's 8 articles on the website that we've done so far. So you actually want to periodically go back to the website and just check those out. You know, different age groups like to consume content differently. Some people can't stand watching my videos. I'm not offended. I'll do the best I can, but they're not fantastically entertaining. Some people just like to read. So go ahead and check the website. Yes, I do actually write quite a bit as well. So the next segment that I wanted to do, this is more of a question that came in, and I think these are going to be maybe a mainstay in our live streams going forward, because there's quite often, like they taught us in school, if you have a question, there's a very good chance the rest of the class has a question too. So I just pick out something that caught my eye. Oh, that's interesting. Maybe everybody else will want to listen in. So let's answer one of those questions.
Welcome. You've got mail.
Okay, so what we're looking at basically, here is the question. Oh, wow, I've got a lot of windows open already. How did that happen? So here's the question. Hopefully everybody can see this. Basically, he said, why do some of your performance charts only show the start value of $10,000 but nothing higher? Okay, and I did a little teaser here. Logarithmic versus arithmetic y-axis. So what I mean by this, and I'll give you an example really quickly, this is our Iron Condor strategy. Or actually what I can do before that is I can show you an example of something that does have something higher. So what he's essentially asking, where's the performance? This is our total portfolio solution. You can see over here it starts at $10,000. And we launched in January 2012, so we've been going over 12 years now. You can see up here it says 100,000, but there isn't a whole lot marked in between that. It's basically just 2 numbers with a massive range, right? So he's asking, well, why is that? Essentially, it has to do with logarithmic versus arithmetic charts. But like I showed you, this one here goes from 10,000 and it doesn't show anything. The reason for that is that this strategy has not yet gotten to the 100,000 mark, right? This one, we've been trading for 12 years. The total portfolio, it is up over 1,000%, which means that it has gotten from 10,000 up over 100,000, and this will be visible. But our Iron Condor strategy is roughly 17% a year, so it's a little bit lower than the broad portfolio, and it has not yet reached that mark. So essentially, what the difference between these two, I'm going to keep this very basic because maybe some people are interested, some aren't, but essentially an arithmetic chart is where the y-axis of a chart is based on price, and it's linear. It's 10,000, 20, 30, 40, 50, every whatever the scale is on the left side of the chart, it's linearly showing upwards. So it may or may not reflect the best data. A logarithmic chart is different. It's exponential. So instead, it is actually more percentage moves showing the relative difference in changes. So I'll give you a couple examples here, and you'll see right away what I mean. This is our Iron Condor strategy. This isn't a logarithmic chart. You can see what it looks like, right? Pretty consistent. Now, if we show the exact same chart, same performance, identical, except the only difference is, look over here on this scale, now this is arithmetic, 10, 20, 30, 40. This is what people are used to seeing, at least when people are maybe trying to be a little bit deceptive. And I'll get into why this can be deceptive. Essentially, this is not showing the true visual performance of something. This is showing a linear scale. So it actually becomes very difficult sometimes, depending on how extreme the performance differences are, that it won't actually be showing very accurately. Best example I can think of, there's a couple here. This is Bitcoin. Again, you can see here, this is the price of Bitcoin. It went from pennies up to almost 70,000. Now it's down to 45. I think it actually cracked 50, 52, I think it is now, 52,000. But you can see this chart. I mean, visually, if you know something about Bitcoin, does this represent what you remember Bitcoin doing? Because it looks to me, just visually, that this is an absolute epic disaster, and everything else outside that is just a fraction of the drawdown, right? This one doesn't look very big at all, and obviously visually, it looks like nothing happened at all for the first 3 or 4 years. But of course, this actually isn't realistic. This is still an arithmetic chart, but you can see the drawdowns. This one that spans a pretty big chunk of the chart is actually lower than this little one here. And there's no drawdowns visible before that. So now let's plot Bitcoin on a log scale, and you can see the difference. Now this is visually what actually happened with Bitcoin. No doubt this is a drawdown, right? It was a 76% drawdown, but this one was actually bigger. This one was the 83. And going back before that, if we dragged it back another year, we would have seen some 80 and 90% drawdowns. So this shows visually much more accurately what's actually happening. The second thing, because we are volatility traders, you'll be interested in this. This is an arithmetic chart, obviously completely useless, on the VXX. This is back to 2004. Now, just quickly, it didn't actually ever trade at 6.3 million. This is a split adjusted chart. So whenever there's a reverse split in the VXX, it bleeds down, reverse split, price goes back up. They actually just, when you show the prices going back, it reflects an insanely high number. It started at 100. It didn't touch 6 million, don't worry. But split adjusted, it has gone from 6.3 million down to 15. This is a totally useless chart. I mean, what can we possibly learn from this? This looks insane. Looks like for the last 10 years, nothing at all has happened. But if you want to see what VXX actually looks like, you plot it on a log scale. And it looks like this, much more in line with what we think the VXX does. Most of the time, the decay is fairly consistent. You can see recently, the decay is no better or worse, no larger or smaller than it has been going back since the financial crisis. And before the financial crisis, in the early 2000s, early to mid 2000s, it was also decaying like that. Just the financial crisis stopped it from happening. But you can see as well, the drawdown specifically, the pandemic drawdown looks visually just about as big as the Great Depression, or not the Great Depression, the financial crisis, which is about accurate. But here, obviously, we can't even see where is the pandemic, where's 2020, right there. Big drawdown in the pandemic, right? We can't see anything. So that's the point, is that for me and my performance visually, I have basically shifted everything over to log charts. That happened several years ago. But whenever you're looking at charts online, the first thing that you should look at is what scale are they actually showing you? This is what we sometimes call chart crime, because when somebody's trying to prove a point to you, it's very easy to manipulate the chart scales and show you something that visually you're like, wow, look at that, that's incredible. And then you actually further examine it and you realize, no, actually they're not showing the full picture at all, and it's not nearly as diabolical as whatever they're trying to show you. So be very careful when you're looking at charts like that. You always want to look at the one that will best reflect what you're looking at. So a general rule of thumb, I would say, is that if there's a performance record that's quite recent, maybe 3 to 4 years into a strategy, it's totally fine to show an arithmetic chart. And if the low to the high is actually fairly consistent or close as well, let's say it's performing reasonably normally, like a trading strategy would, that's hedged and conservative, you can also show those on arithmetic scales, at least for 5 or 6 years. But if it's something like Bitcoin, or if it's something like even Tesla, for example, you really have to make sure you're looking at a log scale, that the bottom axis starts at a normal level and it goes up exponentially higher like that. They didn't, crop a little section in there. So that answers that person's question. Why can you sometimes see 10,000 and then nothing else? It's because perhaps the strategy has not 10x'd yet. It has to actually 10x from 10,000 to 100,000 to actually start seeing those numbers. So be aware of that. What was the next segment? Oh, so ask your questions. This next segment is actually just for pure amusement. I think some of you are going to find this quite funny. Maybe you won't, I don't know, but I received an email recently that, you got to see this email. Okay, social media fails. Not really social media, but this is kind of funny. So ask your questions. There aren't actually that many. I think that's because I took so much time off. People don't actually know we're live streaming right now. But I'm going to read half this email, and then about halfway through, I'm going to show you the email because there's this one just really funny part. So are you ready to hear something? Somebody emailed me this very recently. So it says, I've made the decision to cancel my subscription to your service, but thank you for the great year. So that's not great news. We lost a subscriber. It says, I really like your service and I learn a lot from you, but I don't forgive your recent Twitter post. Uh-oh. It says, my dad was a very good golfer and he would always tell me to never trust anybody who cheats on the golf course. He said, don't be friends with them and definitely don't do business with them. You posted on Twitter that your wife shot 97 golfing, but you didn't mention it also says you shot 66 on the same scorecard. Obviously, you're just trying to get internet clout with your fake score, and I don't know why. You always seem like such an honest and genuine person. Why would you care what people think of your golf game? So pretty scathing so far. You want to see where he goes into the big bold letters? So this is what the email looks like, the rest of it. He says, in big bold letters, I pay you for your investing strategies, not to lie about your golf game. My dad golfed his whole life and only shot under par once. It's actually really hard to do, and you should know that if you're a golfer. You remind me of those idiots who post themselves bench pressing 300 pounds with fake weights. That bothers me as well. Just stick to the VIX. That's what you're good at. I may come back in the future for your options course, but I've lost respect for you after this, and I need a break. BTS was great, but I just don't trust liars. So I just found that funny. I just wanted to share it with the community. But I actually don't disagree with this person. This is actually quite funny, where the part where he says, don't ever trust somebody who cheats at golf. Some people might not understand that statement. So as I mentioned, I was a former professional golfer. I assure you I've shot, not to brag, but I've shot 66, 100, 200 times. I don't even know. I'm not saying it's normal and easy, but it's a pretty regular occurrence. Anyway, not neither here nor there. Actually, I can show you the tweet. It's actually pretty innocent. I was super proud of my wife, and so I posted somewhere here. I posted this tweet. I basically just said my wife shot her best round ever today, 97 on Jumeirah Fire. And Jumeirah Fire, this is why I put this course, or this part, it's actually a really difficult golf course. So her shooting 97 was just awesome. But you can see on the scorecard, I don't know if I can zoom this in. You can see, I didn't sneak that in there to gain any internet clout, I assure you. But this person apparently thought I was. But why is that such a big deal? Why is cheating at golf such a big deal? So essentially, golf is one of those weird sports where cheating is a much bigger deal than, say, soccer or basketball. Like in soccer, for example, these guys are taking dives intentionally. And if you think about what you're doing when you take a dive, let's say you're acting like you were tripped, but you actually weren't, right? You just flat out lay down on the ground, rolling around, screaming. You are intentionally trying to disrupt the game. You're actually trying to lie and change the course and the outcome of that game. You're hoping to get a penalty kick when it was totally undeserved, right? So this is why there's referees there, because these guys are cheating constantly. Like basketball, they're always going to try. If there's no referee there, they're going to take the extra step. They're going to travel so they can get that incredible dunk or whatever they're going to do. There's no marshals and nobody watching you golf. Like even in the highest level professional tournaments, there's a marshal on the course. If something happens, you can radio in and they'll send somebody over there. Maybe 5 minutes later, the marshal will show up. You explain what happened. But basically, it is all self-governed. So this is why cheating at golf specifically is actually such a big deal. So this guy leaving because I was cheating at golf, like I said, I don't want to make too big of a deal about this, but the 66 was legit, I assure you. But it is actually kind of a big deal if you find somebody cheating at golf. So some people say I don't share enough about my private life. So I do have an Instagram, and people can see that. There's that post again right there. Just total side note, she actually about a week later shot 90. So just absolutely crushing it on the golf course. Super proud of her. But actually, I think I've posted 3 scorecards in the last 2 years. This one here, it's actually pretty hard to fake scores in a tournament. If people don't know my name, this is my name. Sometimes I'll post it if it's, if you were good at a skill and it had nothing to do with your business, but you just wanted to share your private life, I'm sure if you shot, if other people shot 65 in a tournament, they might post it on social media. That's all I was doing. I wasn't, I can bench 300 pounds and bring in a duffel bag of fake weights and put it on and, post it. I actually do know how to golf, but golf's one of those things that if you ever see someone cheating, if you ever hear someone cheating, I kind of actually agree with this person. I don't know if he should have left or not, but don't trust somebody who cheats at golf. It's a self-governed sport, as we call it. It's the gentleman's game. I'll actually give you a rough example. So there was a tournament way back when I was in Phoenix. I was playing golf, professional tournament, and I was doing pretty well. It was the 3rd round. And, if I finished the tournament, I would have made, I don't know, $5,000, $10,000. I wasn't going to win or anything. But I hooked my drive in a bunker. I think it was the 6th hole, and went into the bunker. It's this huge, massive bunker. I thought it was what's called a waste bunker. So I went in and I hit my shot. No big deal. I think I made par in the hole, and I kept going. Finished my round and thought nothing of it. The next day, I hit it in actually the same bunker. So hooked my drive again. It was in the same bunker. And the second day that I went in there, I saw a rake in the bunker. Now, what that means is this is an actual sand trap. It's not a waste bunker. Difference being, in a sand trap with rakes, it's deemed a penalty if you touch the sand. So I knew the day before, I thought it was a waste bunker. So I grounded my club, as you normally would in a waste bunker. But I remembered the next day, oh no, I actually shouldn't have done that. So what I had to do, nobody saw me, nobody said anything. It was literally the next day. I could have just kept walking, but I disqualified myself. I said, look, guys, I just realized this is actually a bunker. Massive bunker. It was like 400-yard bunker. It was totally innocent mistake. And in Scottsdale, everything looks like desert anyway. So it was a totally innocent mistake. Nobody would have known anything, but I disqualified myself because golf is the gentleman's game, and that's just what we do. Totally different than other sports. Hockey, they're trying to fake stuff to get other people in the penalty box. We don't do that in golf. So to this person who doesn't trust me anymore, I'm sorry. I do know how to golf, and I do trust your father, the lesson that he passed down to you. Don't trust somebody who cheats on the golf course. That is absolutely a no-no. So, yeah. Let's get into the Q&A. I don't know if people are interested in that. I was just laughing when I read that. Well, I was shocked at first, but then I was kind of laughing. Yeah, it's great. I haven't been, reamed out like that in quite some time, so that was a lot of fun. All right. What is the significance on a relatively flat VIX yield curve? So I wouldn't read too much into it, and the only reason I would say that, by the way, follow me on Instagram. What is that? VIXX brings up some boy band in Korea. VIX Central. The reason that you might think that this is a reasonably flat VIX futures curve, you have to remember that we are actually on the tail end here. Well, maybe it's not the tail end. We don't know until it's over. But we've been on a very long trend. I've got a couple of recent articles. I can actually conveniently tie this back to the fact that I do actually write. The first one I will show you is this one. This one is showing we actually entered all of our positions back in November. We haven't taken any trades hardly at all in the last 3.5 months. We've just been making a really nice profit. There's no reason to exit. The market has been stable and calm. Why would we take additional trades when we don't need to, right? We're trend followers. We want to make money, and we have been. So, but the point is, this has been a very, very long trend. It says 59 here. I think we're over 70 now. So it is actually the tail end of something. And I wrote about something else in a different article. This one is also interesting, where, again, very long, awesome trend, but the correlation with volatility and the stock market is breaking down, where you can see stock market raging higher, as we have seen, but volatility is also going higher. Now, if you know a little bit about volatility, it is typically inversely correlated, right? The VIX and the SPY is inversely correlated, which means if the SPY goes up, 70% of the time the VIX goes down, and vice versa. So it is a little bit weird to see volatility going up and to see the VIX futures curve so flat, given that the market is so calm and it is at all-time highs. So to answer your question, it's a good observation, but what I would say is this is very likely the result of a somewhat complacent market where you can imagine, let's say you have, and this is not a good way to trade, right? You would never use this for trade signals, but if you were to measure the amount of bullish and bearish people, let's just say it's, mostly bearish because the market's been going down recently. Then it bounces and it goes up and the market starts to recover. You'll get more and more bullish people, but you'll reach a point along that line when it starts to tip again, because emotionally investors get very uncomfortable when the market is calm for an extended period of time. So you might see more hedges being laid on. You might see people exiting trades that they, maybe they have no reason to exit. They're just the type that says, oh, well, obviously the market's going to crash any day now. And so that's probably what you're seeing. And this is actually quite common. The longer the trend goes, the more muted or the more flat that curve will probably be. And you will see a breakdown of the long-term inverse correlation. You might actually see, until the market actually has a full-on correction, you might see volatility being quite highly positively correlated with the stock market for a little while. So again, great observation, but I don't think it means anything. We still have to stay in the trends for as long as the signals allow us to. We're not going to exit just because I feel in my gut that I want to be a contrarian. I'm going to just flip a switch and I'm going to be the first person to catch that volatility spike. It's not going to happen. So that's what I would say. It doesn't mean anything, but it's something that typically happens. Investors just... I don't know. They just don't trust rallies like that. You can see all over Twitter, people are just going crazy, like, oh, the market should never be here. Well, it is here. So trade the market you have, not the market you think you should have. Here's a question. You mentioned in a past live stream that there was one rudimentary volatility filter to use that would beat, buy, and hold S&P. What was that filter? If I don't remember what you're talking about, but I would say all of them, and that's kind of a cop-out, but I mentioned earlier that I'm doing these 2 courses, this one here. There's actually a 3rd course that I'm planning after I finish this one, where I'm going to go into each of these metrics and show people what would happen if you split it up, bullish and bearish. So for example, the VIX index, what do we know about the VIX index? Just statistically speaking, the lower the VIX is, the better it is for a short vol net long equities position. The higher it is, the more risky things become and the worse it is. So if you just split it 50-50 and you only shorted the VXX when the VIX was in its lower 50th percentile, I could show an entire series ranking all of our metrics, and at the end of it, we can decide which one is actually the best metric when you divide the market in half. And I would say on a risk-adjusted basis, all of them will do that. So if you just know which direction, even just the VIX futures, even just the VIX Central. If you knew what the 50th percentile number was, and I'm going to take a stab at this, I think it's roughly, let's say 6.3. So anytime the VIX futures contango is over 6.3, you short vol, and it's below 6.3, you go to cash. On a risk-adjusted basis, that by itself is going to beat the risk-adjusted return of the S&P. Now, I suspect it'll also beat it on an absolute basis. But to answer your question, all of our metrics, all of them will do that. That's the point. Now, I combine them all into my volatility barometer, so it's even more robust, but not actually remembering what live stream you're pulling from, I would just say, do some research, do some back testing. I think you'll find that volatility metrics are a very good initial first step to quite handily be able to beat the S&P. And again, because you're only in the trade 50% of the time and you're in cash 50% of the time, it may not always beat it on an absolute basis, but it would certainly beat it on a risk adjusted. So cop-out answer, let's say all metrics. And I'm not going to tell you which one is the best. I know which ones are, the top 3, top 5. But wait for that series to come out. I think it's going to be pretty enlightening. Okay. Let's see. You did once say, okay, hopefully my memory's good, that you wouldn't set the requirement for a VTS strategy to be a very specific volatility number. switching to QLD when the barometer hits 36.72 instead of use round numbers like 35? Why don't take specific numbers when the backtest is better? What's the upside of using round numbers? So this is a really good question. I like this one. What he's essentially saying is, let's just say, for example, I'm going to use strategic tail risk because it's one of the only strategies we have that is very direct on the barometer level itself. The other strategies we have, of course, use volatility metrics, but not specifically this exact value. So this number currently right now is set at 55%. SPY shifting to cash, and this will be a position this year. I think just because of the interest rate situation, we could actually look to sub in an actual strategy or an ETF here, like bonds, real estate, utilities. You know, we got a number of choices, and I'll do a full live stream on that. But the flip point is 55%. His question is essentially, why would I use 55? Because with modern software and with backtesting, I could just, grab a couple of coffees and I could backtest that strategy. And I can tell you that 55% is not the most ideal number. It's just not, right? It's not going to work out that way. Like he said, the ideal number, that one that shows the maximum performance on a backtest, it might be 53.85. It might be 56.21. I could find that exact number, and then I could use that number going forward. But what's the point of that? I know that in this range, it's accomplishing the goal of the strategy. You can mine anything you want going backwards, but there's no reason why it would repeat that way. That actual percentage line will be changing over time. So if you do your backtest today, it might say the ideal number is 55.2. And then you do it 3 months later, that number is going to change. Now it's 49, or now it's 54.95 or something. It's going to be very, very close because I'm doing the strategy for a reason. It flips at that moment for a reason. But there's no reason to backtest everything and use those optimized numbers. That's just what people do to wow people on Twitter. But I have no reason whatsoever to think that 55 is going to be any worse than 54.8. It just doesn't matter. So what you do is you try to accomplish the goals of the strategy and be consistent over time. It just happens that sometimes there's a little bit of a kink there, like maybe we've got different threshold values. So let's say here, flipping from gold to VXZ. If I change that by 1%, you can imagine that there would be times when the market during the pandemic went from 89 to 90. But if I used 90.2, I wouldn't have caught it on a live strategy. But how does the backtest tell me that the exact same thing is going to happen going forward? It's a meaningless number. The market does not repeat down to the exact value. So what you want to do, and it's not actually 55, that number changes every year. So what I do is I do look back into history and I check the percentile and the percentage of trades that I'm allocated to something. So that's not actually 55%. What that means, and this is getting very into the weeds specifically about my strategies, but that strategy, I would like to be in the S&P 500 55% of the time. That's what that means. I want to be allocated 55% of the time. So every year, I have to update my volatility data. I have to redo everything. Once per year is fine. I don't have to do this every day or every month. And I decide what is the new value to make sure that in the past 17 years, whatever the backtest window is, I can be in the position 55% of trading days. That's what that 55 means. So there is no reason for me to, post something different. It's actually, I think right now I could give you the number. I don't want to give too much away here. 54.81 looks like a recent test. So again, 54.81 is not better than 55 starting tomorrow. It means nothing. The market's not going to repeat in the same way. So I have no reason to believe that 54.81 is better than 55.0. It just isn't. But to answer your question, what time frame do you want to do this on? I've mentioned it before. At the end of every year, I basically do a once per year audit. That's plenty to be changing thresholds and updating data, updating my volatility data that goes back to 2004. Every year, we just add a little bit of data. So 2020 was a very meaningful year because we had a massive crash, right? Pandemic, huge recovery. That's good volatility data, and we included that in all the barometers. A year like last year was a fairly consistent, stable year. Not a lot happened. So, it's not an overly instructive year. It doesn't add a whole lot of robustness to the volatility data. But I do it once a year, if that answers your question. That was a way of me trying to answer your question, but not give you the exact way that I design my strategies. I got to keep a few of my cards hidden here. But yeah, once per year is absolutely plenty. Adjusting it now is not going to save me next month. The market next month is not going to be the same as the market, 2 months ago, 2 years ago. It rhymes, but it doesn't exactly repeat, put it that way. Which of the three main strategies has the most sensitivity to an increase in the VTS volatility gauge, or does it vary? Which strategy would typically go to cash or safety first on a drawdown? I get it. Yes. So the first strategy, again, all three of them are using different metrics. So it is always possible that the order that they move to safety is different, right? This one is here. Tactical volatility looks to be the same spot, and strategic tail risk looks to be the same spot. Now, if they all switched on the same day, this is still diversification. Like you'd think, oh, well, that's not diversified. They're all changing position on the same day. Well, this one's going to cash, this one's going to gold, and this one's going to utilities. That is definitely a diversified safety portfolio. So even if they switched on the same day, it would still be a diversified strategy or portfolio of three strategies. But fortunately, with additional diversification, all three of them are using different metrics, different volatility metrics. So different combination of all the information, plus some other things. If you wanted me to say what happens most of the time, strategic tail risk most of the time will be the first one to move to safety. This is, I'd say 80% of the time, 70, 80% of the time, this one is geared towards the most safety. I would say these are probably tied, but to tie this into the previous question about the flat term structure, our tactical volatility strategy is much more specifically geared towards VIX futures style metrics. And this one is a little bit more geared to S&P 500 metrics. All volatility metrics, but a different focus at a different area of the volatility complex. So there are times when this one would be very slow to react, and that would be when the volatility is very steep. Right, when everybody's stable and calm, this one actually might take a while to exit. But right now, because the VIX futures are actually pretty flat, people have probably already started front-running their hedges. This strategy, I would guess, and again, I have no way to quantify any of this, but I would guess that right now, this one is on edge. It would not take very much at all in this strategy. One down day in the S&P, like if the S&P drops 1.5%, say, on Monday, I suspect that would be enough to kick tactical vol to the sidelines. Defensive rotation probably wouldn't because the S&P 500 is near all-time highs. The S&P specific metrics are super stable right now. The volatility VIX futures metrics are actually already starting to roll over. So you can see how I've constructed my portfolio so that not only do we have three different strategies with three different focuses of volatility metrics and three different ETFs that we rotate into, it actually means that even though all three of them are typically net long the market, net short vol, it is actually a diversified portfolio. You need all three. Sometimes I get emails from people saying, well, why do you have three? Just simplify it. Just use one. Well, you could, but that's worse than three. Three is definitely much, much better performance-wise, and diversification, drawdown reduction. So they're totally different from each other, even though those thresholds, roughly speaking, if you were to just have a general mindset that I'm going to be net long the market, net short vol, 65% of the time, you are well ahead of the game. If you just start with that assumption, that's your initial premise, you are already probably going to beat the S&P 500. The problem is most people are allocated to stocks 100% of the time, and they're very reluctant to exit and cycle out into safety. So you're going to be subject to every single catastrophic drawdown, and that's going to take you years to recover from. That's why the average investor sucks. That's why asset managers suck. They're managing these portfolios. They're very handcuffed and restricted. They can't cycle out into safety on Monday. If there's a crash on Monday, I'm going to be cycling out into safety, and by Tuesday morning, our portfolio is going to be either flat or could actually be net short the market. We can do that because we're nimble. Asset managers can't do that. So they're just going to be like, oh, well, here we go. The market's going to correct. It's going to pull back. Just hang in there. Don't sell your stocks. Everything will be fine. A couple of months, it'll all recover. That's the style that they do. So like I said, if you were to just know one single thing about the market, that you are better off being net long the market 65% of the time and in safety 35%, you're already going to be better than 90% of asset managers out there. So that's just a general lesson of diversification. Now, I don't like 65 exactly, different strategies, different thresholds, but yeah, 50 to 70 and moving into a different set of 3 different assets is always good. You know, safety being utilities. Utilities is probably the best safety, but cash, gold, utilities is a great combo. And, you know, bonds, gold, utility is also a pretty good combo. So we're covered. We're totally diversified. But, yeah. Strategic tail risk will cycle out first most of the time, and then the other two, it's going to be a battle depending on how sensitive the VIX futures are. Hopefully that was a good answer to your question. I wouldn't leave for you cheating at golf, talking about golf, however. Oh, well, there's another thing. So that's interesting. Thank you for the comment. There are, I'd say about not half. Most people are interested in my life, so I guess I can take that as a compliment. But there are definitely people who, if I mention anything outside of trading, it's over. They're just going to tune out. They're just, what is this guy doing? I'm following him for volatility stuff. He's talking about golf or running. Who cares about running, you know? And then there's tons of people who email me all the time that, why don't I share my life? Why don't I talk about all the other things I do? So it's kind of an even mix. Some people like to know the person that they have an investing relationship with. So it's tough. You can't please everybody. There's that old saying, you know, if you try to please everyone, you end up pleasing no one. So what I end up doing, I try to stick to the general rule that 90% of what I talk about is specifically investing related. And there are times when I might go off on a little side tangent of golf. But like I said, try to have a little bit of understanding that, let's say you were a top lawyer, right? You're a very good lawyer and people pay you for your services and you're a great lawyer, but you're also a black belt in jiu-jitsu, whatever it is. You're really good at something else. Are you honestly telling me that you wouldn't fire in a few jiu-jitsu lessons that might have some crossover to your legal profession or you growing a business? Like I've mentioned it several times, being a pro golfer and playing tournaments for a living, basically for 17 years of my life, even though golf and investing are just polar opposites, there is a lot of crossover between these two skills. I felt very well prepared for an investing career because of my golf career. I've actually written about that. I've done videos on that. I'm not going to bore you because it sounds like you're going to leave if I keep going. But yeah, don't overlook the fact that there is crossover in this world. Some people, if you're good at one skill, there's some excellent life lessons to learn. And yeah, sorry, I'm a former pro golfer. You're going to hear golf analogies from time to time. But it's not crazy. It's not like I'm giving lessons. I'm not going to pick up a club and start, you know, teaching people on a live stream. The large caps were particular. Yeah, when he went just all bold. Of course, I blew up that email so we could read it, but it was like 3 times bold lettering. It was crazy. Actually, the golf email is interesting for a different reason. Supposition is not the same as evidence. The golf card was not evidence of what he claimed. That is very true. But I think what he assumed is, and it's hard to talk about this without sounding like an arrogant prick, but there are very few people who can shoot 66. So he, you know, he for good reason, if he knew nothing else about me, if some random guy on Twitter who you think like he's an engineer or something, and you've known him for 17 years as an engineer, and he says, by the way, I just casually shot a 66 today, you'd be like, shut up, you're totally lying about golf. So I can believe that, right? That's a very rare score, right? Now, just for the record, twice in tournaments I've shot 61. So I could hit a ball in my day, but that was many, many years ago. I retired 18 years ago. That's another lifetime. Half the stuff I don't even remember. Finally caught a live from you. Always love listening to your talks. Articulate and clear. Thank you. That's encouraging. We'll try to keep going. Definitely. This year, 2024, as I mentioned in my New Year's resolution live stream that we did, this year it is all about consistency and organizing my thoughts. I am a person who is, admittedly, I get distracted and there's side tangents. Oh, I bet you the people want to learn about this and they want to learn about this. And I go off on all these directions. No, this would be a great course. And I start the course and then 4 videos in, I started a different thing or something. So this year is about, like I said, just to recap, we're basically just focusing on 4 things this year. And people will be interested to know that I'm going to stick to this. So number 1, portfolio solution course. I'm going to get through this. This is going to take a while. 1 per week-ish, take a while. Volatility metrics. This is going to be interesting for everyone. The third thing is going to be regular live streams because answering questions is awesome. Like I said before, I want to be a place where people can get their questions answered. There's very, very few places. Like you can DM people on Twitter. Oh, I love your stuff. I read your article. Hey, can you answer this question? Very, very unlikely they're going to give you an answer. So I want to be the guy that I will sit here and I enjoy it too. So it's not like you're putting me out, but I will be the guy that sits here and answers all the questions. And then the last thing is we've got to get our VTS Options Academy up and running again. It was very, very popular for a number of years, and I shut it down because I got too busy. I'm a one-man show, but it is very important for me to get it back for everybody because certainly now it would have been a little bit convenient if I had somewhere to sort of organize some trades in a different structure. Right now, we've just been riding these positions, and look, I'm not saying that I want the market to crash. I'm fine just collecting all this money. We've been net long, double leveraged the NASDAQ net long. I mean, this strategy made 83% last year, and it's already up, easily double digits this year. It's awesome, right? This one was up 80. This one's up 20. It's been fun, but there's been no trades. So, admittedly, there's been a few emails from people saying, hey, what are you doing? I'm paying you for a subscription and there's no trades. What do you want me to do? You want me to exit these massively profitable market trend that we are in right now just to get more trades? So it would be nice if I had the VTS Options Academy to say, hey, don't worry, these strategies are trend following, but these ones, you can churn your VIX options every single month. You can open, your butterflies and your UVXY butterflies every month. We can Wheel of Fun. I've been churning the VXX Wheel of Fun every single week for, a decade, basically. That always is a trade that's available to us, but I got to get that VTS Options Academy up and running again. Did that one. Wasn't negative on you or your life, but on golf itself. Wait, your picture is golf, no? It looks like your background is a golf course. I can see a little sand trap there. So either I'm totally blind and I'm seeing something different, or yeah, I don't know. Maybe you're just love-hate relationship with golf. I get it. Golf's one of those things, people love it or they hate it. Golf is a very hateable thing. Like some people, it annoys them to play, and it certainly, they don't even understand how somebody could sit down and watch other people play golf. It's already the most boring thing in the world, and you're going to sit on a couch and watch people play the most boring thing in the world. So I get it. Believe me, I get it. Oh, here's a good one. I made money on VXX last week. Okay, how? How did you do that? Because it for one day it spiked up. There was that one really bad day for the S&P 500, but then it gave it all back. So are you saying that you were long volatility, which is not something I support, remember? Remember, you should not be a contrarian. Trying to time those volatility spikes, definitely a futile endeavor. But it seems like you maybe caught one, and then did you keep your money? If you kept your money, that means you got out of the trade in time. So good job. It's not something I do, but I always love when people make money, so good for you. Given how long the current trend has lasted, would you recommend that a new subscriber enter all the same positions or wait for the next trade signals? This is a question that comes up not only during a long trend, but every single person who joins VTS. So let me just give the generic standard answer. The way that I calculate my signals, every morning, I wait about an hour after the market's open, and then I gather all my volatility data. So that would be all the data related to the volatility metrics. Takes me about 30 minutes to gather. It's a long, I've shown the spreadsheet before. It's a very big spreadsheet with a bunch of data. I collect all of that, and then I give the trade signals. So technically speaking, these trade signals that you see in the email, SVXY, this was a signal that was sent out on Friday, QLD, SVXY, SPY, right? Technically speaking, these are one-day trades. Now, we've been in the QLD for 3 months. There is no reason at all to exit. Not once did we exit, not a single time. But technically speaking, these are one-day trades. So anytime you log into an email and you get something from me, whatever it says, that's the signal for that day. I basically do everything as if I'm looking at it with fresh eyes. I'm in cash. Here's the volatility metrics. What's the best position today? No influence from yesterday at all. Doesn't matter how much I'm up or down on that position. Doesn't matter how long I've been in it. What is the position today? I get it and I send it out. Obviously, if it's the same position as yesterday, I'm not going to sell it and re-enter it, so we just maintain. But technically speaking, these are a series of one-day trades. So if you look at it that way, there is no reason not to enter what you see in my emails on the day. So that's the one way that you can do it. You can just say, well, if he's been in it for 3 months and he's very profitable, he's up 100%, I'm going to join on Monday at 0, but whatever happens on Monday affects us both equally, right? If it goes up or down 2%, we both lose the same 2%. Don't get anchored to your cost basis. That is a totally irrelevant thing in the investing world. I understand it's a mental block that people have. They really think that cost basis matters, but it really doesn't. It's just to one-day signal. I don't know if this trend's going to last another 2 months or if it's going to end in a couple of days. I have no idea. So that's the first way you can do it. You can just have confidence that these are one-day trades. I look at it with fresh eyes every morning, and that is the best position for that day. If I had new capital on the sidelines, Monday morning it's going right into the QLD, SVXY, and the SPY. That's the best position. But of course, the other way you can do it, if you're just not mentally comfortable, sure, wait for the next change of position. That might mean you're in cash a while, or the markets crash very soon, and maybe you get into trades on Tuesday or Wednesday. You move to the safety positions. So you would enter XLU utilities, you'd enter gold, right? You can do either one of those. When you stretch the investing time horizon, we are investing for multiple decades. It's not a year or two, right? So nothing you do in the next month or two, as long as you don't just blow up your account, but anything you do is not going to make a blip on your long-term chart. So do what you're comfortable with. You can either just get in on Monday with whatever that email says on a one-day time frame, or just sit on your hands and wait for the next change of direction. Both are just fine. Neither will influence your performance a whole lot. When you look at it over 20 years, I'll be here for another couple decades, don't worry. Okay, I was wrong. That's not a golf course. It's Disney World on the gondola. What? This picture's too small. Doesn't look like that. I think you're golfing. You're scared to admit you're golfing. No, I'm just kidding. Okay. One thing I've noticed with the Iron Condors is that it has been harder to get a sense of tactical timing lately. Mid-2023, it seemed clearer, maybe due to higher volatility. Well, the thing about Iron Condors, they're a fantastic strategy. And it's not really a strategy, it's just a trade structure. But the way that we trade them, Iron Condors are really, really good for most market environments. Now, this is a little bit counterintuitive. People don't typically understand this, but Iron Condors perform better in more volatile markets. They perform the weakest point of an Iron Condor strategy. The worst situation that you can have if you're trading Iron Condors is a slow, steady climbing market. If you imagine what would happen in these two scenarios, one, the market has a steep pullback correction. And the other situation, for 3 straight months, it's just nothing but consistent, slow, steady gains, up marching to all-time highs. Which one of these is better for an Iron Condor trader? Well, definitely the pullback, the correction, steep market crash. Because what's going to happen? Well, the person who is in an Iron Condor and the stock market steadily climbs, in a couple of weeks, he's going to reach his stop loss. He's going to take a losing trade. The person who has a crashing trade, they're going to reach their stop loss in 2 days. They're going to stop out of the trade. Now, what about the next trade that these two people take? The one person that was stopped out on the high side, they have to open a new Iron Condor that is Vega negative, net short volatility, when volatility is even lower than it was the first time. So this is an even weaker trade the second time than it was the first time that it stopped out. And then the market continues to trend higher. That one stops out even faster than the previous one did. What about the person on the other side? Well, he took a stop loss trade as well in 2 days, and it was scary, but they lost the same amount. So now the second person gets to open a new, fresh Iron Condor with high volatility, and his condor is going to be very wide and well protected. It's very difficult to imagine that the next trade is also going to get stopped out. That's going to be a very strong trade, the second one that he opens. This guy that's watching the market march up for 4 months straight, every single trade he opens is worse than the previous one. Market crash, every trade you open subsequent is a better trade than the previous one. So eventually, the guy that's trading market neutral Iron Condors in a market crash, he's only going to have 1 or 2 losing trades, and then those are going to be so wide, so strong, and net short Vega that he's going to start getting winning trades before long. It's not going to take very long. This guy, the guy who's getting stopped out on the high side, he could continue getting stopped out for 3-4 months straight. I've actually, let me show you the performance. This is our Iron Condor strategy performance. And of course, I will show you a log chart because I talked about that earlier today. So this strategy did launch live at VTS in January 2012. It was one of the original strategies. This is the performance. Now, the largest drawdown, you can see because it's a log chart, this isn't the biggest drawdown, the recent one. We're 10%. This is the largest drawdown, 15%. When did our biggest drawdown happen? Mid-2017. What happened in mid-2017? Why was that such a big drawdown when the pandemic, nothing, Volpocalypse, nothing? These are not 2022, this strategy made 26% in 2022. Stock market was down. How is that possible? Why is the biggest drawdown 2017? Well, what happened in 2017? It was the lowest volatility year on record. The market was just steadily going up. Volatility was going down. The VIX was printing 9s. That is a horrible environment for an Iron Condor trader. It's the worst situation you can get. So I actually had my largest drawdown when the stock market was at its most stable. So your question, why is it so difficult in the last 3 or 4 months? That's why. We are currently in the worst environment as an Iron Condor strategy that you can get. A slow, steady, all-time high, low volatility climb. That's the worst. Because every trade that stops out, an Iron Condor has a margin of error, let's say 5-6% in a low vol environment. Market goes up 5%, stop out. Market goes up 3%, stop out. 4%, stop out. Every trade you take after that is worse than the previous one. This sucks. Now, if the markets, let's say I was in an Iron Condor today and the market crashed, that trade's going to lose money. But it's only one trade. We only allocate a very tiny percentage to each individual trade. So my second trade's going to be awesome. That's essentially what's happening is you are experiencing not the same as 2017. It's not quite the same. But remember, volatility should be viewed on a relative basis. VIX isn't printing 9s, but right now volatility is low, considering, Volpocalypse, pandemic, 2022 market crash. It's very difficult to even fathom that the VIX could be touching the 9s now. But a VIX of 13 now is relative basis kind of the same as a VIX of 9 in 2017. So right now, it's just the worst environment for Iron Condors. And guess what? This has been bothering a few people as well. I get emails every day. Well, what is going on? Why are you not taking new trades? Well, this is why. Why am I just going to walk head first into something I know? This is just a bad environment. Volatility is too low. You could do calendars, which we do. You know, the Iron Condor mega course that people get access to. It does include a section where during low vol, you do transition into calendars. What lesson is that? Calendar. We start doing calendars around lesson 1920. When you have volatility so low, calendars are better, but it doesn't save you. This is a situation where I am just doing the smart thing. I'm trying to keep maybe one, because you never know when the market's going to cooperate, right? So you should get a little bit of exposure. Maybe next week we'll take a new one. But I'm not going to load my portfolio with 3 layers. Why would I do that? This is the absolute worst situation. So that's what you're experiencing. Good of you to notice it, and thank you for allowing me to explain. I might actually cut that clip out and send it to the community because, believe me, a lot of people are asking that. Well, what is going on with Iron Condors? You know, sure, your QLD, short vol, stock market, I understand why those ones are not trading, right? We're making a bunch of money. We're not going to give it, I'm not going to just forego the profit. But how come you're not trading Iron Condors? Let's go, you know? Well, that's why. It would be a mistake. And I don't like unforced errors in trading. I don't mind cash. Cash is an active position in my mind. There's nothing wrong with cash. When cash is better than a position, then cash is the position, isn't it? It's just, you have to start viewing investing as not, I'm allocated, so I'm trading. Being non-allocated sometimes is the best trade you can take. So that's how I view it. Would you then stop using Iron Condor strategies when it's not an ideal volatility environment? You probably asked this about 5 minutes ago. And resume the strategy when your metrics show that it's worth to use them again. Exactly right. Now, like I said, it doesn't mean we have to have zero exposure. I have been opening trades, and as you've noticed, we have been getting stopped out. I think 5 of the last 7 have stopped out, right? They're very small allocations, but yeah. And oh yeah, here it is. I see it. Never mind. Yeah, that happens on live streams. But yeah, exactly. That's what we're going to do. We're going to just, each strategy is going to target its best volatility environment. And look, full disclosure, sometimes the VTS community is going to be boring because I never, ever do anything just to impress a paying community of subscribers. I will never send out a trade just because I think, oh my God, if I don't start trading, these people are going to start unsubscribing to my strategy. I better get this ramped up action going. It is what it is. If we don't take a trade for the next 6 months, the community paid me money for 6 months for 0 trades. That would happen. But there's no chance I'm going to sacrifice the performance of the portfolio just to appease the paying subscribers who want a little bit more action. Like I said, the best thing that I can do is deliver the very best performance I can and then also have a VTS Options Academy where I can say, now we can focus on the stuff that's really working well. Because my VIX options is crushing it. You know, like I said, nothing wrong with selling VXX put options here. That's a great trade, layering those week in and week out. It's just, I'm not a, you know, on Twitter, the Twitter traders, I always call them Twitter traders. I'm not a Twitter trader. I'm managing the portfolio as if I have 0 subscribers and it's nothing but my own money. Don't care about what anybody else thinks of what I'm doing or what I'm saying. If I deliver the best results, I'm doing my job. And it's just, unfortunately, the last 3 months, there has been very, very little action. So, yeah. Have to go. New computer just arrived. I was actually thinking of getting a new computer just because. So what I don't know what you got, but I was thinking, I've been an Apple fanboy for I think way too long at this point. I was going to get the, what is it called? Huawei, however you say it. It's weird. I speak Chinese, but I don't know how to say Huawei. Just to get a PC and just to see something different. So I'm just waiting for the new model. I guess there's something called X16 or something like that. It should be coming out soon. So yeah, I'm with you. New computers are fun. I do actually love my MacBook. There's absolutely nothing wrong with it, aside from the fact that it's just brutally expensive. Like $5,000 for a laptop? That's a little much. But I'm a fanboy, so I just pay whatever Apple tells me to pay. All right. In your course that explains what volatility is, you tell us to figure out how much the market is expected to move. You divide by the square root of the time frame. Do you know why square root is used? Well, it's just to annualize something, right? Square root of, well, not necessarily to annualize, but typically we say if you're trying to calculate the VIX and see the expected daily or the move, monthly is usually what people show, then you do the square root of 12, right? But if you're trying to show daily, you would do the square root of 252 for trading days. If you're trying to do weekly, you could do the square root of, whatever you want, 52. You can take the VIX index, which is essentially an annualized value once you divide by the square root of whatever time period you're doing, but you don't have to do it on a monthly. You can choose any time frame you want. So it's just the square root itself is how to take something that is a 30-day volatility look over a 1-year period and normalize it for a period that you're looking for. You just have to do that. I don't know if I can explain exactly why you would do that. It's just that's how you normalize the values. Because the VIX, it's a statistic, right? It's a statistic based on another metric. It just is what it is. In order to manipulate that data, there's a specific way that you have to do it. I don't know. I don't know any other way to do it. All right. I think I got every question. So what time is it? 1:06. That's perfect. 1 hour and 6 minutes. I think there was so few questions today just simply because I haven't live streamed in so long. I don't think many people even knew we were doing this today. So it was a little bit boring with the segments today too. But every week I will try to have at least one segment where it's volatility related. I think people respond best to those ones. Talking about UVXY or volatility metrics, different trades you can do on the VIX, stuff like that. So, all right, yeah, like I said, thumbs up, please. There's currently, looks like about 2.5 times as many people sitting here listening to me as there are likes on the total video. So let's let YouTube know that I'm alive and well, and there are a few people who like to listen to what I am saying. So on your way out, give it a like. We will be back, and next week there will be another part of the course. Like I said, we're going to just build that out in structure. If I slip, email me and remind me. Say, what are you doing? You said that you were going to do this course. You were going to go start to finish 30 weeks in a row. You missed a couple of weeks. What's going on? Keep me honest. So thanks, everybody, and have a good weekend. Oh, yeah, UFC 298 tomorrow. I won't bore anybody with the, what I got here, my interests, my UFC boxing interests. Absolutely stacked UFC cards. So I'll just give this final plea. If you're ever on the fence about the UFC and you think, yeah, should I get interested in this sport? Should I not? It would not be a bad time to start to become a UFC viewer, because 298 is absolutely stacked. That's tomorrow, basically tonight, but tomorrow, because I'm in Dubai. And UFC 300 is coming. So that card is just sick. So anyway, UFC. Just buy the pay-per-view. Thank me later. Thanks, everybody.